Hey, good afternoon, everyone.
Good afternoon.
Yeah, hi, Alicia. How's
Good
everybody
afternoon.
else? Good afternoon. All righty. Looks like I have 7 people today in the collaborate, and I'm sure I have more people in today's forum. Okay. Um, well, that's just about the same number. Right? I have 7 here, and I have 7 here. So I have um, matching number. All righty. Let me quickly check where we were last time. I believe. Hmm, hmm, okay, I believe we did this example, and probably the other ones we didn't. Um, but let's do this. Okay, so um, we were talking about the different yields, right? First, current yield, and then yield to maturity. We talked about this last time extensively, so I'm not going to go over this again. Now, so then how do we solve for yield, right? In other words, um, most of the times we were solving current yield is, it's easy. It's annual coupon over uh, the selling price of the bond, right? The market price of the bond. Not a difficult thing. And theoretically, we know what it is. It's internal rate of return, which is the rate, the discount rate that makes the right-hand side of the equation uh, equal to the left side, which means in when bond price is given, right? The unknown is from this formula, right? The the unknown is y, right? The discount rate. And I just hate to go over the same thing over and over again. But if I just uh, if I just explain it verbally, you just not too many people can easily uh, catch on. Not too many people can easily catch on. So whether I like it or not, I'll have to go over it. So we are not solving for the price, right? If this is the question, right? Um, we're not solving for price. Uh, this is the question. This is the unknown. Why is the unknown? And so everything else is given. Everything else is known, right? Of course, face value is always 1K. N is also known. Payment is known, right? Because coupon rate is obvious. Um, most of the times previously, previously, what we were solving for was the price. In other, where did I go? There can be two questions about the bond. One is very often we just, we are asked to solve for the bond price. So this is the unknown in that case. And R is known, right? The discount rate is known. But but you should be able to also solve for the occasion where the Y, the discount rate, is the unknown, right? And then, so think about it. The left-hand side of the equation is known, it's given, because it's the market price. You just look up the price quotes, right, reported in the news media. So that's easily, found. But then, there is, also the coupon payment is known because, all bonds have, coupon, as long as they are coupon bond, they have, a stated coupon interest rate. Maturity is known. So the only thing that is unknown is the discount rate, and there's only one value. There's only a unique value that can satisfy this condition. This condition is what? The right hand side of the equation is equal to the left hand side of the equation, right? And to satisfy that equation, to satisfy that condition, there can be only one unique value. Finding that's our question. Okay, so let's take a look at this example, row 22. And if you have downloaded this file, so please open it. Okay, and we're in the slide. Okay, what's in the slide? Here's here's that example. Yield is found already here, but look, this is exactly that example. And that example is coming from, I don't know if this was already shown somewhere. I don't think that the verbiage was never given. But from this given data, we can tell what it is asking for. So it's exactly this. And then you might wonder, something you wonder. So let's see. Future, the face value, $100. Can it be $100? I mean, coupon payment, $1.75. Price, $96. No, this is totally it's totally out of proportion, right? It's totally out of proportion because face value is not $100. Face value is 1,000. You can tell it's out of proportion, or off scale. But you remember, at the beginning, you saw this, how the bond prices are quoted. And do you remember the bond prices are basically, bond prices are quoted not in dollars, but in percentage, right? The percentage of par value, if you remember, right? It's not $91.73, but that means 91.735% of the face value. And we all know face value is $1,000, right? Right? Face value. So it's basically, okay. It's basically, percentage, right? You learned that the bond prices, when reported in the news media, print media, or not even, it doesn't have to be print media only. Bond prices are basically quoted as percentage of the face value. So therefore, what this in this example, what this is telling you is not $96 or $100. It's actually $1,000. And think about it. Coupon rate is 3.5%. 3.5% of 1,000 is $35. So half your coupon payment must be $17.50. Okay, and the price selling in the market would be $962.80. Actually, it's the replica of the this one. It's the duplicate of this example. And this example, it's expressed in dollars, right? But I had to, but to use, to solve for the yield, I have to use, yield command in Excel's built-in function. So to use yield command, I have to put it this way, right? And also time zero and the maturity date must be given to use that yield command. Okay, so maybe what you have when you downloaded it, it may have a dollar sign. You can get rid of the dollar sign, right? All the dollar signs can be gotten rid of. This you can change it to today's date, right? Or originally it was something like so I linked it to this. Originally it was like 2017 something. Doesn't matter, right? What matters is 4 years from time zero, right? So I guess someone was please just ask, okay? If you drop something into the chat box, I can't see. I will have to switch the switch the screen. So if you have a question, go ahead and ask. Did someone ask a question? I said go ahead and ask, please. Don't just I only hear this ding, ding, ding. But then I have to, once again, I have to switch the window. I cannot see the way when I have this file open, I cannot see what's in the Collaborate. I have to
Professor,
switch to. Mm-hmm.
there's no question in the chat for you. One of the classmates just asking if we can hear her. Perhaps
Oh,
maybe she was trying to answer something. I don't know.
okay. So okay. Thank you, Claudia. Thank you.
No problem.
So, Kelly is saying, can you hear him? So Kelly must be having some audio problem. audio issue. You'll have to adjust your volume, speaker volume, okay? Or, okay, so where was I? All right, so in the original file you downloaded, right? There must be $ there, but you can get rid of $, $ here, there, you know, because it's not, but that still it's the same thing. It means, you know, 100% of the face value, and 96.28% of the face value. Okay. You can use today's date. I mean, you know, it doesn't matter. This was Tuesday, right? Tuesday's date. So if today is April 26, 2022, this bond has 4 years to maturity. And then, so I automatically, you know, I built it to already built into the cell what's going to be 4 years from today. Now you cannot just add E22 because the way Excel recognizes calendar date, a time, the way Excel recognizes time is by days. So this 4 will be recognized as only 4 days by Excel. Okay, so so to make it, you know, really 4 days, you have to multiply it by 365, and then it must be added to this date. Then, you know, that's how it comes to this. And you probably this is, you know, just out, but you know, for any computer, the beginning of the time is January 1st, 1980. I mean, January 1st, 1900. January 1st, 1900. That's the beginning of the time for all the computers' clock. And every day after that will be number of years times 365. Okay, number of years times 365. So if it is 2022, it will be like, you know, 122 years, right? Times 365, right? Plus the 0000, which is, you know, 1900, January 1st, 19. And any date prior to January 1st, 1900 will be subtracted. It will be minus that, you know, January 1st, 1900 minus 100 years before that, 100 times 365, right? That's how the computer's clock works. So you should understand why it is, you know, why we have to do it this way. But anyway, so let's find what is the yield to maturity for the bond that has 4 years left, currently selling at $962.80. So we're gonna basically, we're finding basically the rate, the APR, but you know, to use the yield command. My mouse is acting up again. Come on. So you go to the function, and in the dialog box, of course, whatever comes up is the most recently used, and the yield command was not recently used, it's not going to show up there. For me, it shows there because I've used it recently. But otherwise, you got to go into the financial category, scroll down to Y, right? Because it's the in alphabetical order, right? So select yield, and then it just give it what it's asking for. Settlement means settlement date. Settlement means you you made that the purchase date. Why? Think about it. If you bought this bond today, I mean, we are, even if you didn't really buy this bond, right? Even if even if you don't buy the bond, you can just assume that you are buying the bond today. And why today? Because today is um, the price of the bond that we want to find is today's price, present value as of today, right? And then think about it. If you buy the bond, you have to make the payment, right? Until you make the payment, you still have the account to settle, right? And when you make the payment, the account is finally settled. That's why it's called the settlement, okay? Settlement date. And maturity date, this is the maturity, right? This is the maturity. Rate means coupon rate, okay? That means price. Redemption value, of course, this is the redemption value. Again, everything is expressed as percentage, right? I mean, the dollar prices dollar values are all expressed as percentage of par value. Frequency, the bond frequency is always 2. Bond is on semi-annual cycle. So as you enter that, we got something here already. So you hit OK. Voila, you got 4.53%. That means this is the discount rate. That makes the right-hand side of this equation equal to the current market price, which is 900 and what was that? 960 something, right? It makes the 962.80. That's the 962.80. Okay, so 4 point something percent. .53%. Okay, now so then is that the only way you can find the yield? No. Is that the only way you can find the yield to maturity? No. We can also find it by, and I told using rate command. And remember, the reason I put the instead of just R, I put IRR there. It's because it's called internal rate of return, right? From the last class, you should remember this, right? The rate that makes the right-hand side equal to the left-hand side of the equation, that's called internal rate of return. So it's basically a rate command. Now we can express everything back in dollar terms. And here, so current market price of this bond is 962. Well, why is it in parentheses? Parentheses means, negative number. And I've been telling you, in Excel, if you want to use Excel's built-in function, it's basically a financial calculator. And in financial calculator, all cash flows must be classified either as cash inflow or cash outflow. And cash outflow is negative because it leaves your pocket, right? It's cash outflow. So it's not really a negative value. It just means, cash outflow. Okay. So that's why, but unless you make this distinction, right? Excel's built-in function doesn't work. So basically here, we're going to use the rate command first. So we will have to find a periodic rate, and then we can turn it into annual rate. So back into the financial category, right? Scroll down to find rate. And there you go, rate. And give it what it's asking for. N period, this is N. Payment, that's the payment. Present value, that's the present value. Future value, that's the future value. Type, you don't have to bother with this because in annuities, right, there are only two types, ordinary or annuity due, right? Ordinary or due. And I told you, if it is ordinary, you leave it blank or 0, enter 0. If it is annuity due, you enter 1. And why? Because the difference between annuity due has one more compounding. That 1 means one more compounding. So when you do that, you have already something showing here. That's 2.26%. Well, again, that's half year rate. So the full year rate, we know what to do. Whole year rate, we just multiply by 2. And then we get exactly the same number, 4.53, right? So that's how you find yield to maturity, either by yield command or the rate command. Now, we can find price. We've done this all this time using the formula, right? But again, without using the formula, we can use Excel's built-in function. There's a price function. So again, go into, and then there is, a financial category and price. Hit OK. Give it what it's asking for. Settlement. This is the settlement. Maturity. This is the maturity date. In this example, it has 15 years left, right? Coupon rate is 5.5. Discount rate is, so in other words, yield to maturity is 6.5. So rate, as I told you, it means always coupon rate. Yield, this is yield. Redemption value, this is the redemption value, right? Frequency, of course, bond is always, frequency for bond is always 2 because it's semi-annual. And there you go, we got something here already. So hit OK. You get 90.51% of the face value. 90 point. So that means in dollar value is 905 and 10 cents. $905.10. So did everyone get the same result? Let me verify. Did everyone get the same result? You are dead quiet. You are awfully Alicia, did you get the same result? Alicia? Bralin?
Still doing it.
Okay, still, I'll give you a few minutes. Bralin, did you get the same result? Bralin? Claudia, did you get the same result? Kelly? Nobody's answering. Lorraine, did you get the same result?
I'm here, Professor. This is Claudia. My laptop is acting up. It keeps cutting in and out of Wi-Fi.
Okay, all right. But this Excel, you can, once you have downloaded, you can do it without a Wi-Fi because the file is already on your computer.
Oh, no, I understand. I'm saying I was trying to answer you, but I couldn't get the mic on.
Oh, okay, no problem. Take it easy. Now, Mukhtar, did you get the same result? Mukhtar? Maria, did you get the same result?
I just got disconnected. I'm trying. I'm still trying, Professor.
Okay. All right. I'll give you, a few more minutes so you can. Mukhtar, are you there, Mukhtar? Prita, are you there, Prita? Kadir, did you get the same result? Ronisha, you got the same result? Sapphire? Okay, I will have to assume that you are all there. But I can check later. I will show you later how I can check if people are logged in or not, or if they're away or not. So I'll turn this into a formula view. Oops, not there. But then when it is in formula view, can't see really well. Okay, so I may have to see, this is the problem. If I'm in formula view, you can't really see it well. Okay, so for now, this part is important. This is the part that's important. So the solution cells. All right, so I'll leave it there like that for at least another like 3 minutes. You see, I don't know if you have noticed, but when I turned it into a formula view, T0 is showing as 44,677. So what does that mean? I mean, that was supposed to be um, some like April something, 2022. But if you think about it, you divide it by 365, you will see it's going to be 122 something. So what does that mean? That exactly speaks to my point, right? I said, time zero on any computer is January 1st of 1900, right? When if you reset the clock on the computer, that's like 0000 right? That 0, 0, 0, 0, 0, 0, right, is when that is January 1st, 1900. And try that, a plus 122, 2022, right? All right, so I'll just leave it like this, just one more minute. So I hope you got it by then. All right, let's turn it back to normal view. Back to normal view. And the rest of it, this one you can easily do by simply copying this, pasting here. I mean, you can do it from the scratch again, but and I probably explained how I found that the examples were taken on June of 2010, because I could figure out n from the given input. I could found n, right? And by n is 11.71 semesters, which would be 5.86 years, and from this maturity date, right? If you take it back 5.86 years, right? Then you get June of 2010, right? All right, so that pretty much wraps up everything about the all the examples in the bond valuation. There are only two things left in the bond valuation. One is call, right? So the bonds, there are callable bonds and puttable bonds. But this is something you can just read up, right? And how to make adjustment to pricing, the valuation model. You can just read up. It's not really difficult. Also, we don't have time for everything, because again, everything is fully explained in the main lecture video. Everything is fully explained. So you should study the main lecture video. Do not rely entirely on the Collaborate, because Collaborate is just a review and reflection. Okay. I believe we talked about this. I think we need to talk about. Did we? I believe we talked about this, didn't we? Basically, how you how you predict the future interest rate movement, and how you take advantage of that to maximize your return on the bond. So, for example, you anticipate long-term interest rates to drop from 6% to 5.5%. Long-term rates means, the annual yield, right? Yield means annualized return on long-term bonds. So it's, all the returns, all the rates are basically annual, but short-term bonds have lower yield than long-term bonds. And you understand, this from topic 1. It's called maturity risk. The longer the maturity, the higher the return should be. Otherwise, there's no incentive for anyone to invest in long-term bond. So the rates will fall. How do you know the rates are going to fall? Actually, the Federal Reserve is constantly communicating. Federal Reserve is constantly communicating, right? What they are going to do. So we know, after every FOMC meeting, they hold, a press conference, and they basically, tell the entire press what their, policy will be like. And so this is called guidance. So when they say, we're going to raise interest rate, by 50 basis point in May, I mean, it is being considered, and that means most likely they will do that. So, I mean, but if the rates are expected to fall during the next year, and if the rate changes, what will be the total return for 20-year 6.5 coupon bond? This is the coupon rate. And we can tell already this is going to be a premium bond, because the coupon rate is greater than, even currently, it's greater than the discount rate. In the future, it will be more. Next year, it will be more premium bond, because the discount rate is even lower, 1% lower than. So we can easily find the current price of the bond by plugging in, to the formula, right? Coupon is 6.5, which is $65 a year. You divide it by 2, so this, and then 20 years left, so that N will be 40, right? And 3% coupon, the discount rate is 3%. Why wasn't it 6%? Of course, 6%, but you must divide it by 2, right? And if you do that, it comes to 1,057. Next year, there will be only 38 semesters left, because next year T will be 19 next year, right? 19 years left to maturity. Coupon is still the same. It's always, it's fixed. Half year rate 5.5, right? Divided by 2, right? So if you do that, you get even more, right? So here, there is even capital gain. There is even capital gain of $59. And then during this year, you have earned interest of coupon interest of 65. So your total proceeds, or total return from this bond, holding this bond 1 year, is this. And then, but to buy this bond, you had to pay this price. So you divide that by the price. This is your holding period return, right? The holding period return will be 11.74. Just want to make sure if I'm sure I talked about this in the last class, right? Let me check. never mind. Because I don't want to waste time on something redundant.
I'm just saying because the only why that you ought to get transaction.
Okay, so it looks like I did it. All righty. So now, interesting thing is the reason I'm talking about this is now think about it. The bonds over the life of the bond will show two price patterns, right? Now think about it. From time zero to maturity, time zero to maturity, right? At maturity, all the bonds will be worth $1,000. Isn't that right? Other than the municipal bond, all the bonds will be $1,000 at maturity. Now, premium bond at time zero, premium bond is above 1,000, right? And the discount bond is below 1,000, right? At time zero. But over time, premium bond will go down, right? The price, the selling price of the premium bond will go. It goes without saying because eventually it will have to approach 1,000 at maturity, and the closer you get to the maturity, the price would have to lower. The price will have to go down. The price will have to be closer to 1,000, right? Because the reason this bond is premium bond is because it pays higher coupon than the higher coupon interest than the prevailing market rate. And the longer the maturity time left to maturity, there are more coupons to collect. So thanks to that, right? The price would be way above 1K at time zero. But as time goes by, fewer coupons are left. And with fewer coupons, the price will have to be lower, right? Now, discount bond, as time approaches maturity, the price will have to go up because, it should be closer to, as time approaches maturity, the price should be closer to 1,000. So this is the general pattern you will see. In other words, in case of premium bond, over the life of the bond, there will be capital loss. And in case of discount bond, over the life of the bond, there will be capital gains. However, this is assuming that R is fixed, right? If the discount rate is constant, or yield to maturity, if yield to maturity is constant, then definitely it will show this pattern. However, just as you've seen, if the discount rate changes, right? If the discount rate goes down, it may show this pattern. And if the discount rate goes up, right, it can show this pattern like this. Also the same thing, as the discount rate goes down or goes up, it can show this pattern. sometimes it's above, sometimes below, right? But overall, the trend is capital loss overall. I mean, sometimes there can be capital gains, right? Some years there can be capital gains. Some years, there can be capital loss, right? Even for, even for discount bond, there can be capital loss, right? Some years, sometimes. So that's something you have to but think about it. When the interest rate goes down, every financial asset benefits. Why? Because why? Valuation, pricing is basically what? It's the present value. And as long as the valuation of any asset is the present value, right? The discount rate plays an important role. If the discount rate goes up, then the whole fraction goes down. If the discount rate goes down, whole fraction goes up. Now that brings us to then the question of interest rate risk and reinvestment rate risk. Interest rate risk and reinvestment rate risk. Interest rate risk is also, it goes by three names: interest rate risk, also price risk, and maturity risk. Okay, they mean the same thing, interest rate. So please read this. I can't, we don't have time for this. So please read this. And also, interest rate risk and reinvestment rate risk are counteracting each other, counterbalancing each other. So please read. So it's 2:55. So it's a good time to take a break. Let's take a 10-minute break and come back. And we're going to start on the new topic, risk and return. Okay. So 10 minutes. All right, we're back. We're back. So now we're moving on to the new topic now, risk and return. Excuse me. So risk and return, right? So here, we're gonna basically, we all already know a lot about what return is, because from the topic one, right? We talked about holding period return, and we know holding period return is if n is the holding period, right? PT plus n minus PT, price at time t, right? Plus all the cash flow during the holding period divided by PT. So holding period in this case is n. But you know, the holding period, you all understand that holding period can be in any shape or form. In other words, it can be years, or it can be months, it can be days, or it can be even hours. It can be, quarters, So we'll just assume that these are years, right? N years. And then remember in our first example, PT plus N is the price of the house N years later. PT is the price of the house at time T. And let's say time T is, time zero when, we first bought the house. And obviously then this difference is called capital gains, right? You remember that? And then additional cash flow is the rents, right? That come in every month. But I told you this is like a scenario. This is like scenario 2. Do you remember scenario 1 and scenario 2? Scenario 2 is the case where you sublet the house, so there will be a rental income. If you sublet the house, I mean, of course, there will be capital gains or capital loss, depending on, how house price has moved. And, by subletting the house, you will get rents, right? There's rental income. However, in scenario 1, so I told you, scenario 2 is like coupon bond, right? It's like coupon bond. Scenario 1 is like zero coupon bond. That's, when you don't sublet the house, you don't rent out the house, then, there's no rental income, but there will be just capital gains. Now, stocks can be also like this. It can fall into under scenario 1 and scenario 2. Now, stocks, if this is a stock, capital gain or capital loss, and this will be dividends. Oops, what did I press? What did I? And in case of stock, this is dividend, right? In case of bond, it would be coupon, right? Coupon interest in case of bond, right? If it is bond, coupon. If it is, stock, it will be dividend. Now, Some stocks don't pay dividend. Dividend isn't always, mandatory. Whereas, non-dividend paying stocks, I mean, it depends. Some stocks pay dividends, and then for they stop paying dividends, and there is a period of no dividends, and then they can start paying dividends again, because dividend depends on EAT, the net profit, and if the company doesn't have any positive net profit, they cannot pay any dividends, right? So it goes without saying. But now the question is, so let me, I should have put it in the, now our, so if I rewrite, okay, so now let's think about it. The reality is, we don't know. I mean, if PT is now, if time t is now present, right now, time t plus n is n years later. I mean, if n is years, right? There's no way you can tell what time t plus n is, right? Because n years later, how do you know what the price will be? So in reality, the better way of writing this is the latest price, the most recent price, that's PT. And then if your holding period started n years ago, yeah, PT minus n, right? If your holding period started n years ago, that's more realistic because you have the data. You have the data. In other words, price at time t, and you have price at time t minus 1, price at time t minus 2, and so on. You have the data all the way from time t minus n to present, which is time t. And then you have all the cash flow during those n years. Okay? So this way you can find, holding period return. But what if the n is 1 year or 1 month, 1 quarter? I mean, let's say n is 1 year. So if the holding period is just 1 year, now then it becomes, if holding period is 1 year, it's a single period return, right? Holding period is a single year, so single period return. And in that case, it's very, fairly straightforward. It will be PT minus 1 because holding period was 1 year. You bought the stock just 1 year ago. So we have the price data of the stock 1 year ago and price data now. And then, as I said, if this is a dividend-paying stock, they pay dividends quarterly, right? If they pay dividends, they pay dividends quarterly. So there will be at least 4 dividend paid during a year, right? And then you divide it by PT minus 1. Okay, so this is a single period return. But what if n is 1 month? What if n is 1 month? Now here's, then obviously we don't have this. This drops off Because dividend is paid every quarterly at the end, quarterly, right? So there is a particular month that the dividend is paid out of 3 quarters, out of 1 quarter, which is 3 months, right? 1 month you have dividend, but the other 2 months you don't have any dividend, right? So for a monthly return, this is going to be difficult because this is not general. You cannot generalize dividend payment, right? Um, some people might say, why don't we just, divide it by 3 and allocate it evenly um, to every month? No, you can't do that. Why? Because that's not what really happened. I mean, data means, that's what happened, not, what how we want it to be, right? Price data must show exactly the price movement, not, how we want it to be. So this becomes a problem, right? So, but there's a way to handle this. So here, let's actually get the data to find return. So I want everyone to go to Yahoo Finance. And if you go to Yahoo Finance, I want you to look up. Are you all there? Are you in Yahoo Finance? Let's see how many people. Alicia, did you go to Yahoo Finance?
Excuse me?
Are you in Yahoo Finance?
Yahoo Finance?
I just told you to go to Yahoo Finance. You are not. Go to Yahoo Finance. Okay, go to Yahoo Finance. Bralin, are you in Yahoo Finance? Bralin. Claudia, are you in Yahoo Finance?
Yes, Professor.
Okay. Kelly, are you in Yahoo Finance? Kelly, are you there? Lorraine, are you in Yahoo Finance?
Yes, I am, Professor.
Okay. All right. You're getting there. Maria, are you in Yahoo Finance?
Yes, I am, Professor.
Okay. Mukhtar, are you there, Mukhtar? Okay. Prita, are you there?
Yes.
Okay. Are you in Yahoo Finance? Okay. Kadir, are you there? Ronisha, are you there? Sapphire, are you there? Sapphire, yes. Okay. And in Yahoo Finance? Go to Yahoo Finance, okay? And then let's look up Apple, okay? Every semester for the last 20 years, I've been following Apple. So as you type in, you don't have to even type in AAPL, which is Apple's ticker symbol. When you type in A, it comes up. In the old days, even in 1990s, you can only look up by ticker symbol, which is AAPL. But now you can type in just Apple and it comes up. And then I want you to go to chart. I mean, just wanted to show you, just wanted to mention. I don't know what your setting is like, but in my setting, I usually use 5 years. This is weekly price. I want you to select maximum, right? Max, and then this is weekly price. So instead of price, they used percentage. So instead of that, I would want you to select 1 month, monthly price. Then look, Apple came a long way, right? Apple actually went public in 1981, so it's been more than 20 years, 40 years, right? This year it's 41 year. And at the beginning, you might wonder, oh, it was just 12 cents. No. IPO price was like about $10. Why is it saying 12 cents? It's because all those splits over the last 40 years, Apple had several splits, right? So after split, then they will have to adjust the pre-split price to be in line with the post-split price. Okay, so think about it. It's something like this. If currently you have a stock that is $100, and let's say the stock went to the stock split. If this stock had 1 to 10 split, what does that mean? You had one share of this stock, which is $100. Now you have 10 shares, and each share is $10. So when after split, you don't lose anything. You just have more shares, and you're holding your position. The dollar value of your position is still the same. Okay? But think about it, then if the split happened today, as of yesterday, the price was 100, and as of end of today, the price will be $10. And then if you don't make that adjustment or prorate, you have to prorate. If you don't do that, it looks like the price crashed from 100 to $10. Actually, what happened is not a crash, but just a split. So all the pre-split prices must be adjusted to be in line with the post-split price. So think about it. Over 40 years, Apple had at least something like 5-6 splits, at least. And all of these, what do you think they are? They are like dividends when they paid dividends, and these are, splits. There were also splits here. So you can tell there was a period between April 1996 through March of 2012, during which Apple didn't pay any dividends, right? But then they started to pay dividends. So even the most recent 5 years, let's see, 5 years. You see, there was a split, 4-to-1 split, 4-to-1 split actually it was August, end of August, right? 2020. And then look at all these. So that's just the trend. And you can tell Apple really took off since 2007, actually. Prior to that, it did. In 2007, that was, the year the iPhone came out. And then overall, after proration, right? After making adjustment for split, the Apple's IPO price in 1981, which was actually $10, but after adjusting like 12 cents. So currently, 164. So if you calculate the growth rate in Apple, it's almost like 1,300 times. The Apple's growth over 40 years was like 1,000. It's, you know, it's almost roughly 1,300 times, which is in percentage 103,000%, right? Which means if I bought $1,000 of Apple at the time in 1981, if I bought $1,000, right, worth of Apple, 1981, that would be 100 shares. Today, it's obvious. It would have become 1.3 million, right? $10,000 in 1981. $1,000 to me, 1981, $1,000 was a huge, you know, I mean, my ideal salary in 1981. You know, it would have been $13 million, right? But that's 40 years, you know, 40 years. Still, who bids, you know, this 1,300 times, you know, 130,000%, right? But that's just the that's just the overview. We want to get the data. So how do we get the data? We go to historical data. Go to historical data. Okay, and we're gonna select 5-year time frame. That's the 5-year time frame. So it's going to be, you know, April 2017 through April 2022, and we would like monthly data. So select monthly and apply. And once you apply, hit apply, you will see, oh, it's not as of April 1st. I mean, that's just the way the calendar date is represented. It means it's not March 1st. It's as of, you know, it's just representing March. But, you know, as you can see, this close price is what we're interested in. They paid dividends in February. Now, the dividend paid in February is not the dividend from the first quarter. I told you the dividends are paid quarterly. So does that mean this is, you know, first quarter dividend? No, first quarter didn't end. First quarter hadn't ended, right? In February. I mean, first quarter doesn't end until end of March. So first quarter dividend cannot be paid out during the first quarter. It can be paid out in the second quarter. And logically, right, by the same analogy, dividend paid in the February is actually the fourth quarter dividend, right? Fourth quarter 2021, and, you know, successively so, right? Now, you can also see 2020. Oh, they don't show. Okay, split. Yeah, there was split here, August 31st, 4-to-1 split. Now, we need to download this data, so click download. Okay, and open file. It's in your download folder. Now, the way it is now, I don't like this because this default font is not very vision friendly. So I would like to change the font face and the font size. So click here, this corner, and then increase the font to size 14, and then I would use, this font, Baskerville, but I should say the best font is something like Georgia Pro, Georgia, or Times New Roman. And then the font is also important because when you're dealing with numerical data, which is, it may feel like very dry, tedious, dry thing to work with. So at least if the font is unappealing, aesthetically unappealing, you get easily tired. You get easily tired of working with the data. So first I would change the font, and this is the original data, so I will not touch it. Instead, I will copy that and then open another worksheet next to it and then paste it there. Now I'm gonna do whatever I need to do with this data. First, I'm gonna underline, bold, and center align the labels, and expand the column width. The first thing I want to do is to sort the data in descending order. Now what you see here starts from the earliest date is on top. But it will be a lot more convenient if the newest date or the latest date is on top. So what I'm going to do is select this cell, right? Select this calendar date cell and go to home and sort newest to oldest, or sort it in descending order, right? That's descending order. The other one is ascending order. And once you have done that, everything is now in descending order from, right? From the latest to the oldest, okay? And next, we have open, high, low, close. What does this mean? Of course, you should all understand that the every day the market opens at 9:30 a.m. in the U.S. Market opens at 9:30 a.m. Of course, New York time. East Coast time. That means in the West Coast, they will have to open it at 6:30 a.m. And it closes at 4 p.m. So during the during the day's trading, there are 4 price points. 1, price at the opening. 2, price at the close. And high, that means, highest price during the day. Low, the lowest price during the day. But no matter what, no matter how high it reached, or no matter how low it fell, no matter where it opened, it doesn't matter, because these are irrelevant. What's relevant is the closing price. Why? Because closing price is the conclusion of the day's transactions. Isn't it right? Closing price is the conclusion of the day's trading. So I'm not gonna, I will just highlight columns B, C, and D and delete those columns because I don't need that. Volume, I don't need that for now. Volume, I don't need. Okay. Then what we are left with is close and adjusted close. Okay, between the two, I use adjusted close. Why? What's the difference? So I'll delete adjusted the close. And what's the adjusted close? It's adjusted for stock splits and dividends. Remember, I told you dividends are not paid every month. We are dealing with monthly price data, and the dividends are not paid every month. So if we have to, but every 3 months, the dividend is paid. So if that is the case, then making this, and what about the split? So basically, adjusted close prices adjusted for splits and dividends and splits. So then we won't have to worry about making, now think about it. The formula for return, one period, a single period return is it's monthly return. It would be PT minus 1 over PT minus 1. But in the month when there is dividend, you'll have to do this. But then this is not going to be consistent, right? Every month, 2 other months, we don't have this. 1 month, we have this. So it's going to be inconsistent. So to make it consistent, we use adjusted close price. Then no problem. We can work with then just this formula. We can work with this formula, right? So therefore, I'm going to change this draw stop. I'll change the name to now. What happened there? Change the name to PT, meaning it's a time T, right? Now, that being said, now we can calculate return, but then we're out of time. So we can't do this. But I want you to, if you downloaded this file, I want you to save it, because don't leave it unattended, because you've been working on this, and save as. When you try to save it, it will be, the current file format is CSV file, which is not good. It's just like a text file. So you'll save it as Excel workbook, okay? And I will name it Apple 22 Spring section 1401, because you guys are section 1401. I will save it, okay, like that. And we're gonna work on this. We're gonna continue next Monday, okay? But again, we couldn't do this topic today, but it will be on the quiz too. Again, in the main lecture, it was already all covered and discussed. So you don't rely on the collaborate only. Okay, you need to study the main lecture. All righty, so that's it for today. Any questions so far? Any questions? Any questions? All right, I'll take it as no. I'll take it as no. So have a great week. Oh, okay, Mukhtar, where were you when you have a question?
Yeah, I have a question about the test. You said the test will be on this weekend from Friday to Sunday.
Yeah.
Oh,
You don't have to ask me. You go to you can go to, it's already in the announcement,
I just
right? It's already
I just was trying to make sure.
Yeah, but whatever is, think about it, whatever is in the writing, has, it carries weight, not the word of mouth. Whatever is in the writing. Okay?
Okay, I got it. Thank you, Professor.
All righty. So I'll see you guys next Monday. All right?
Thank you,
Take care,
Professor.
everyone. All right, you're welcome. All right, I'll so stop sharing and stop recording.